Hello and welcome to the Space News Commercial Space Transformer series, where we aim to give you a behind-the-scenes look at the people and companies driving the space industry's commercial transformation. I'm Jason Rainbow, senior staff writer at Space News, and today I'll be talking to Mark Boggett, CEO of British early-stage space investor Seraphim, which runs a publicly traded space fund as well as an accelerator program for space startups. According to Seraphim's analysis, the amount of space technology investment has grown for 5 consecutive quarters, really bucking the general VC trend, and the company expects to see more growth ahead, largely because of a surge of new investors coming into the market. Mark, it's always a pleasure. Thank you very much for taking the time to chat today.
Delighted to join you on your program, Jason.
Yes, yeah, I've been looking forward to this one. So Seraphim, publicly traded space fund that sets you apart from other early stage investors. You've been listed on the London Stock Exchange for over 3 years now. How has life been as a public investor? Has being listed helped or created some challenges for your growth strategy?
So it's been a mixed bag, if I'm honest. On the sort of positive side, we successfully IPO'd the fund and raised a significant amount of capital. It also has led to us having a much higher profile, actually, particularly in the US. Our profile has really increased as a consequence of being a public listed company. But likewise, over in Asia, particularly in Tokyo, it's been very helpful to be seen sort of as a public company. The negatives really have been that the stock market and stock markets around the world have largely been closed.
Mm.
There's been little by the way of new IPOs and fundraising, which has meant that access to fresh capital has been limited. So what's that resulted in? Well, that's resulted in us being forced to be a little bit more selective. So it's limited the number of new investments that we've made, adding new companies to the portfolio. And those that do join, they've got an even higher bar to jump over. So and that's no bad thing. So during the last 12 months, for example, we've just made one new investment into the growth fund. We added a company called Skylo that is direct to handset telecom company that is growing very rapidly. It's a fantastic business. It's really scaled since we invested. But we only added one name where we'd probably like to add 3 or 4 annually if market conditions would allow. But the other thing really to note is that despite the fact that the public markets have been a challenge, largely thanks to the defence market, our portfolio has been thriving. So let me just give you a few points to help you to understand that. So we've got 18 companies in the portfolio. Over the last year, they raised $900 million in equity funding. The top 10 companies grew their revenues by on average by 71%. And 60% of the portfolio, as measured by a net asset value, are now either profitable or they've raised sufficient money to reach profitability. Whereas a year ago, that figure was only just 2%. So what we've seen during the last 12 months is really a rapid maturing of the growth companies within our portfolio. And this is largely driven by the defence market, the bigger budgets, and the increasing need to access cutting edge capability that space is well positioned to provide.
Yeah, and the US, of course, still drives much of the activity in space investments. With a Trump
Yes.
administration returning in 2025, what kind of impact do you think that could have on space funding and the industry?
So we're really positive about the outlook there. Well, first of all, sort of drawing on experiences from the first Trump term. He was the president that led Artemis Accords, and driving the race back to the moon and beyond. He also created the Space Force. So there are a number of initiatives there that demonstrate that Trump is pro-space. Not to mention his appointment Elon Musk into a senior advisory role. So we think that that too is going to have an influence on NASA budgets, which we think is likely to be positive. And then if you look outside of the US, and again just sort of thinking about defence, which is one of the sort of key drivers of the sector, you look at NATO and the sort of funding of NATO. You know, Trump was warning all of the NATO members in his last term that they were all underfunding their commitments to NATO. You know, they had stated sort of 2% of GDP that they needed to be committing towards their defense spending. Most of them were woefully below that. And Trump, you know, made it clear that the US wasn't going to subsidize them any longer. Now, most of them are now up to that 2%, but we've got Russia spending 6% of GDP on defense. So now, arguably, you know, that 2% figure is not enough. So I think that, you know, Trump's positioning is really going to end up driving significant further defense spending in Europe, which again, a significant proportion of that we believe is going to be filtered into the space industry, and particularly the new space capabilities of the types of companies that we're interested in.
Right, and in Europe, we've just seen the what is it, $11 billion Iris² sovereign broadband constellation get the green light. How do you think
Yep.
that might shake up the investment landscape there?
Well, you know, I think it's positive news for the sector. It's certainly positive for the three companies that have got the sort of leadership role in Iris². Two of them being key backers for Seraphim, Eutelsat and SES. So, you know, if you look at these other major projects that the EU has done, Copernicus, which is the world's largest Earth observation platform, and Galileo, you know, the European equivalent of GPS. You know, those are well-run programs, and you know, I believe that Iris² will be as well. It's going to be federating out this activity to the European supply chain. I think that there's going to be a real focus on working with smaller, innovative companies. So, you know, I think that this is good news for the sector. I think that Europe will make a good job of doing it. So yeah, we think that this is you know, another sort of key driver for positive sentiment in the European market.
And Seraphim, of course, has a strong focus on smaller, innovative companies, and we've seen growing support in Europe to help startups develop new technologies. But what about scaling? Because that's often been a challenge for Europe, and we've seen non-European companies swoop in to buy these businesses and take the lead there. Do you see this dynamic shifting at all?
Well, it hasn't shifted so far. I mean, this was the reason why we originally set up the Seraphim Space Investment Trust. You know, that focuses on growth stage space companies globally, and we've been heavily investing in Europe for, you know, for exactly this reason. No, Europe's behind the curve on addressing the shortage of growth capital that they face. You know, it's a major issue. You know, over recent years, the EU has invested heavily and focused on space through the EIF, and has invested into a whole range of venture funds that are now deploying, but they're all typically deploying at the seed and Series A stage. So I think that this is sort of perpetuating the problem of lack of growth capital in the space sector. So, you know, there are large funds, multi-billion-dollar tier one funds in Europe, and, you know, they do have a passing interest in space, but there really is a big gap when it comes down to growth funding. You know, I believe that there are initiatives being planned in the EU to address this, but in the UK, for example, there's been recent reforms around pension, so that pensions are now being encouraged to invest into private growth stage companies. And this is now sort of being actioned in the UK market, and you know, hundreds of billions of dollars are now being targeted to support growth stage companies. Now, this is something that happened in Canada. It's happened very successfully in Australia, and they've now got really vibrant both pension funds and growth stage companies. So that's one of the things that's sort of going on in the UK that I think is going to have an impact on Europe. But nevertheless, the Europe is exposed to not having the right funding structure to support the growth stages of their rapidly growing pool of space companies. And US, Middle East, Asia will step in to support these companies. But what does that ultimately mean for their focus for the future, for where they might be IPO, where they might be growing out their headcount or even moving their headquarters to? So yeah, this is a problem that still needs to be fixed in Europe.
Okay, and then just from a global perspective again, how far out does your crystal ball go? If you look beyond 2025, what do you think are some of the biggest opportunities and challenges facing the space industry in the years ahead?
So I'm a venture capitalist for my entire career. My career is based around looking in a crystal ball and trying to work out what happens next. That's why we launched the first space fund in 2016 with a view that this market was going to change. So what do we think about the years ahead? So a range of things really, and quite broad. So first of all, Starship and how that's going to redefine the space market. We're excited that 2024 saw 6 launches. They've pretty much got that rocket operational now. So what's that going to result in? What's that going to result in terms of launch cost reduction? How is it going to revolutionize the ability to be able to launch large constellations in a single launch? So we're really excited about how that is going to develop infrastructure in space and the speed with which the space market's developing. So that's top of the list. What have we got next? China and their activities in space. So 2024, in the first half of the year, according to our own space index, saw that China private investment into the space domain exceeded that of the US for the first time ever. So we're currently neck and neck on capabilities along with China. And I think that is really going to accelerate, particularly in the US, investment in the sector, driven by Trump and his ambition to succeed and keep ahead of China on a whole range of stakes. So I think that is really going to be a key driver for activity in the years ahead. But I think next year, 25, I think we're really going to see a huge amount of activity on that. What else? AI in space. That is really going to start revolutionizing Earth observation. So when I think about the opportunity that is now there for the taking, AI is about data sets and about finding, the insights from those data sets, and Earth observation and where the market is now getting to. These companies are now getting to the point of having hundreds of satellites in space, generating new data that's not seen before. And AI has just got to the stage where it's universally available, and we're now going to start seeing the outcomes of that. And that also then sort of feeds into the fusion of these different data sets where you're taking SAR data and hyperspectral data and optical data and crunching these all together with terrestrial data to find out new insights. So all of that is really now upon us, and I'm confident that we're going to see some amazing stuff come out of that in the years ahead.
Good stuff. Wow, that crystal ball is pretty packed. As you look into that, well, how do you go about identifying startups with transformative potential, especially in an industry that is evolving so rapidly?
Yeah, well, it's not easy. We're really focused on trying to identify large addressable markets. So when we're trying to think about a market, we're trying to think about markets that have got current needs that the space market can address. So there is a real market, there's real budgets, there's a real problem, there's real revenues behind that. So that's really sort of top of the list for what we're looking for. And then the next phase is like a technology that is doing something new and is demonstrating leadership and is protectable in some way, patents or something around that. But then the next point, and this is the most important, which is really about the capability of the management team. Now, that is really difficult to evaluate, but it's something that venture capitalists spend years owning their ability to identify signals from entrepreneurs as to their capabilities for fundraising, their capabilities for hiring and retaining staff, their capabilities for setting plans and then executing against them, technology and commercial. So there are a range of signals that investors are able to identify, and us honing on those signals, you know, and increasingly learning how to do that is really what we're looking for. We also run an accelerator program, Seraphim Space Accelerator. We've just concluded our 14th program. More than 100 companies have gone through that program, and that's really a sort of a platform for us to be able to evaluate the capabilities of management teams in a very productive and platform-driven way. So this allows us to be able to really get under the skin of management team and work out quickly what really makes them tick, and then that reduces the risk for them being able to invest into them. So those are the three measures really: market, tech, and then team. But the team is the hardest one out of all of those to get right. So that's where we spend most of our time, and it's really just about, you know, just trying to assess them in a range of different circumstances to work out how they might behave after you've invested in them.
Yeah, one thing I look at a lot is just the kind of increasing sophistication of investors in the space industry, for lack of a better way of putting it. But do you think investors in space just generally need to adjust their expectations compared to other tech sectors? Is there still a kind of a mismatch between capital market timelines and the realities of building space businesses? Or do you see this kind of finally coming to some kind of resolution, as it were?
So, you know, I do think that new investors coming into this market sort of rush in and make investments that I think that they might regret further down the line. You know, I regularly see large investments that are being made into companies where you know, these companies are sort of, you know, might be number 5, 6, or 7 in sort of global ranking, with companies, you know, many years ahead of them with you know, hundreds of millions already invested. So, you know, I think that there is not enough sort of rigor going into some of the decision processes that we see many investors coming into this market. But in terms of you know, the market itself, you know, as I alluded to in one of the earlier questions, the market is really now getting to a level of maturity. So there is now a whole range of companies, publicly and privately, that are valued about $1 billion. Typically, those companies are now approaching or have already just reached profitability. And those companies have typically raised between $300 and $500 million to sort of get to that point. And on average, those companies have taken around 7 sort of years to get there. So I don't think that period of time to reach that maturity is anything really too different from many of the other sort of technology sectors that you would look at, particularly not on the deep tech side when you sort of compare it against biotech and other sort of hardware chip related type investment opportunities. So I think that we are just entering an era where the space domain, the new space domain, is really sort of proving itself that these companies can reach profitability on these new low-cost platforms. And that in itself is then bringing a whole range of newcomers into the market. This is the reason why we're seeing a lot of private equity coming into the market now. they're one of the biggest investors in the market at the moment. Same with sovereign wealth funds. Sovereign wealth funds are only really just dipping a toe in this market now, but I think during the course of the next few years, with a bigger pool of more mature companies, they're gonna dip an ankle, and then they'll dip the whole leg over the course of the next year. Again, this is one of the sort of features that we think is really going to be a driver for the market over the short to medium term. So yeah, I think that the data is there now to prove that these companies can get to profitability in defined amounts of time on defined amounts of capital, and I think that is going to continue to bring more investors into the market.
Good stuff. Thank you, Mark. That's great. And as insightful as always, thank you very much again for your time today.
You're very welcome.